I added a brand new dividend growth stock to my watch list that has a 10-year dividend CAGR of over 24%. So I've been watching a lot of Peter Lynch videos recently, and it's really made me think to start looking at the world around me for investments. Peter Lynch destroyed average market returns for 13 years straight at the Fidelity Magellan Fund, and he consistently talks about investing in what you know and believes that the biggest edge that retail investors have over big hedge funds is investing in the world around them, what they know. So, what did this line of thinking lead me to? Dick's, the sporting goods store. So before we get into their metrics, I just want to talk about my personal experience with them for a bit. I have two younger brothers that both play sports, which causes my mom to go there all the time. It for real feels like she's there every day. She literally went yesterday. Aside from that, if you're unfamiliar, the prices of sports equipment are ridiculous. My mom is constantly telling me about how every year she needs to buy a new glove and they're always more expensive than the last. That's not even the expensive stuff. My brothers have played baseball pretty much their whole life, and the bat prices are unbelievable. Most bats are hundreds of dollars. I think the most recent one my mom had to buy was around $400, and she might have even bought that off of another teammate. Still have, still having to spend $400. It's just ridiculous. My brother's 12. Not only does he have many more years of bats, but also how much are bets going to cost at a higher level, especially when in several years when inflation adds on to this. I was talking to my mom earlier, and she fully expects bat prices to be at least $1,000 in a few years, and she thinks that people will still buy them. Even now, with their crazy new prices every year, she tells me that these parents are still continuing to pay for it. I went to an event for my brother at Dick's one time, and there was a ton of other teams there, and their store was filled to the brim. It was like a team sign up event kind of thing, or I think they were kind of figuring out what team they were on, and all the teams got together. So not only does Dick's have a loyal fan base, but they also play into it, creating an even better customer experience and culture. This is just one sport. Dick's has equipment for a ton of other sports: football, soccer, basketball. They even sell clothes and have camping equipment. So they have a pretty diversified revenue stream. And I know this is just the opinions of one person, but my mom hates Academy relative to Dick's. And honestly, from shopping at both stores, I don't think that's an uncommon belief. There's even a Dick's that she went to that had a rock wall and batting cages. I don't know any academy that's doing that. They're almost becoming like a Bass Pro Shop. I fully believe in the customer loyalty and enjoyment in this company. And with that out of the way, we can look at their financial metrics. Their revenue and net income growth has slowed a bit over the past few quarters, but overall it's still growing. But I'm actually going to move to the annual chart because I found something that I think is really interesting. These past few years, they've had slow but steady revenue growth, honestly expected from a company like this, but as you can see, from 2021 to 2022, the revenue jumped up significantly. This is something widespread across every metric. Basically, after COVID, their numbers skyrocketed. I'm not sure if there's an exact cause, like in the case of Netflix, they buckled down on their password sharing, and that pretty much created a new floor for them. But in this case, I believe it's a mix of COVID, e-commerce, and the opening of curbside pickup. Everyone wanted to get outside after COVID, so people are going to spend a bunch on sports equipment so they can do that. They've invested a lot into their online stores, which has allowed much easier access when it comes to shopping. And in a similar vein, curbside pickup also creates a lot more ease when it comes to shopping. EBITDA in 2021 was slightly over a billion, and in 2022, it was almost at $2.5 billion. That's damn near 150% growth. Net income in 2020 was just under 300 million. 2021, it was about 500 million. And in 2022, it was at 1.5 billion. It pretty much tripled in 1 year. And since then, it hasn't gone below a billion. We're a little over halfway through 2025, and we've already made more net income than 2024. If we look at their free cash flow per share, they have seen steady growth to the upside. They do give out a decent amount of stock-based comp, which dilutes our shares a little bit, but regardless, they've pretty much set a new baseline in this metric as well, where before they had never hit $5 a share adjusted for stock-based comp, but now they managed to hit at least 6 every single year. They really don't have a lot of debt. The majority of it is in capital leases, but I'm really not worried about that. This is where the dividend chart confuses me again. If anyone saw Novo Nordisk in my last video, because this is Dick's 10-year growth rate, so maybe it isn't the starting yield, but I really have no idea. Maybe Novo Nordisk chart is just kind of glitch or something. I don't know. But anyways, they've grown their dividend at an average of 24.3% over the past 10 years straight. A large part of that is probably due to their over 100% increase from 2022 to 2023, and they have slowed to about 10%, but that is still really good growth, and their free cash flow per share has averaged 18% growth over the past 10 years, so they can easily afford it, and they only have a cash flow payout ratio of 25 to 30%, so it's extremely affordable. Their return on invested capital, according to FinViz, is 16%, which is solid. Return on capital employed has been around 20% over the past 4 years. Again, this is solid. If you look at their margins, their gross margins have been steady and they've been rising consistently. Their profit and their operating margins don't look as clean, but overall, it's been increasing, and just like every other metric we've seen, there was a clear jump in 2022 that has basically remained steady ever since. When it comes to their valuation, their PE over the last 10 years does look slightly overvalued. I would prefer it to be more in the 11 to 12 range at least. But if we go down to the 5-year chart, it definitely seems a lot more overvalued. Same thing with price to sales. And when it comes to their free cash flow yield, it's really not that high. I would at least prefer to see this in the 5 to 6% range. I thought this was pretty cool. They haven't spent any money on sales and marketing since 2022, and their growth has skyrocketed. I will say I'm still fairly new to this, so if anyone knows if there's something I'm not getting here, please let me know. Did they for real get away with spending absolutely no money on marketing because they're just a huge brick and mortar store? Or is there some kind of loophole where they don't have to classify certain things as marketing? I don't know. But regardless, no money spent on sales and marketing and huge net income growth anyway. Moving over to the DCF calculator, their PE ratio has been somewhere around 13 to 14 over the past 10 years on average, and over the past 5, it seems to be a lot more clear around 13, and their EPS has CAGR'd at 15.67% over the past 10 years, which means if we got in at today's price, assuming these metrics, we could see a return of 11% on average over the next 5 years. You always want to be conservative with this, so let's assume an EPS growth rate of 12%. That hurts. Oh my goodness, 7.65%. That's really not that good from today's price. But again, if we take into account the other valuation metrics we looked at, this seems to be a bit more in the overvalued territory anyway. So again, we seem to be a bit overvalued, so I'm really not worried about getting into this stock right now. But overall, it seems like a solid company that'll be around for a while, and I'm not against purchasing shares. I have been mulling over the idea of if I really want to buy into a brick and mortar store, because it just doesn't exactly seem like the type of risk to reward that I want. I'm really trying to capitalize on my situation and take as much calculated risk as possible. And I think the overall growth rate of stores compared to something like AI or software, for example, just isn't exactly near what I want. But regardless, I have placed this on my watch list. So let me know what you think in the comments. I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.